Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is getting started with options. With the S&P 500 pushing up to touching all-time highs, just starting to come off those very high levels. I think there may be a lot of traders out there kind of looking down, saying, "Whoa, that looks like a long way down." Some stocks could be turning a corner. Yeah, when we have a concern about risk for some traders, they'll turn to options to try to protect their stock positions and specifically sometimes use what's known as a protective put. Today, we're going to be talking about protecting stock positions using puts. We're going to be doing kind of a demonstration of how that might be done, talking through the pros and the cons. Should be a great discussion. Before we get to any of that, though, let me first of all say hello to everybody who's already chatting in. As always, great to see so many familiar names out there on YouTube. Hello there, Lawrence and Will, Tony and Eva, Paul, Sharon, everybody else. Thanks for joining us week after week. We definitely appreciate your attendance and your contributions here. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, well, enjoy the presentation. Be aware that you're invited to join us in the live discussion. This is a Tuesday webcast series. We kick things off promptly, noon Eastern time. We'd love to have you here in the live audience. And also to assist our live audience members, Connie Hill's going to be hanging out in the chat. She's going to be addressing any questions that I can't get to. Just like with so many of our other coaches, I've been working with Connie now for about 20 years. Been a long time. Connie brings a lot of knowledge and experience to this. Thanks for having my back there, Connie. And Connie and I would also like to issue an invitation to everybody listening. If you have an account on X, you should be following your favorite presenters there. It's a great resource. Best place to connect with your favorite presenters in between the live streams. You can find Connie on X. At Connie Hill CS is her handle. Mine there is at Cameron May CS. But let's get into this discussion of using puts, protective puts, in an attempt to manage the risk on existing stock positions. All right. Of course, with any approach to investing or trading, risks are involved. So bear these important disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including loss of principal, and hedging and protective strategies generally involve additional costs and do not assure profit or guarantee against loss. All right, so topic of the day is protective puts. I want to set the stage for that discussion. So we're going to take a quick look at the S&P 500 first, just to see what a great last 3 months we've had, but also what some people might interpret as a potentially precarious position that has left stocks in. So then we're going to turn our attention to a discussion of using protective puts. We're going to talk about what they are, the potential pros and cons of this approach. We're going to talk about when this strategy might be applied and when it might be removed if applied. So a lot to cover. We'll even include an example trade before we're done. So let's go right to the Thinkorswim desktop, have a look at the S&P 500. And you can see here, I've just drawn in a little illustration of just how strong this recent move has been to the upside. We bottomed out. This seems like ancient history now, but just 3 months ago, look at that right now, as of the recording of this webcast, it is July 8th. So we go back 3 calendar months and we are at the lows of April for the S&P 500. That was 30% that we've traveled upward since those lows. 30%, that's a big move. For some context there, using historical averages, that's about 3 years worth of productivity in 3 months. We are going up about 12 times as fast as normal. So here we find ourselves touching all-time highs just 2 trading sessions ago, and we've peeled back a little bit. Now, that doesn't mean that we're going to just fall from here. We could certainly pull back a little bit, bounce and start to rise again and go right on up for who knows how long. But for some traders, they could be looking back at this recent history and thinking, well, that was a fun ride, but could it be over? We're starting to enter earnings season. That could tilt direction one way or the other. But for some, when there's been a strong move to the upside, their emphasis may actually turn, their attention may turn to mitigating risk. So that's the lens we're going to be looking at things through today. And for today's example trade scenario, we're going to be using Bank of America. So why BAC? Well, in our example paper money portfolio, we actually own 100 shares of BAC that have treated us really well. Purchased the shares at $36. When there's a nice round number like that, what that usually is tied to is assignment or exercise of an option. But in any case, entry price on Bank of America of $36 on the nose. And you can see right now the stock is trading at $47. That's up $11 on a $36 investment. What is that? That's a big move. And as a matter of fact, here's the size of the move that we've seen on Bank of America from those April lows. So BAC actually bottomed just a couple of days later than the S&P 500. So it's actually been just shy of 3 months. And Bank of America has gone up not 30%, but 50% from these lows to these highs, from 33 up to almost $50 per share. But then look at what's been going on since. We hit the peak. We've pulled off for a couple of days, but the selling has been a little bit more dramatic here for BAC. And if we can put ourselves in the shoes of an owner of shares, you can see why they might be a concern. It's been a great run up, but it could be right now that there are a number of traders who are thinking, ooh, that's great. 50%, that's 5 years worth of productivity, setting compounding aside. Maybe it's time to take some profits off on the table. That could be a contributing factor to this selling. What's right around the corner here that could spur additional selling if it's not well received by shareholders? There's an earnings announcement. Banking tends to lead the charge as we move into an earnings season. But there's one other thing that I wanted to point out here from a technical perspective, and that is these price ceilings. We've had 12-month highs that looked like we were getting above, and maybe some might have expected to stay above those. Maybe as they're thinking we might stay above S&P 500 highs. But with today's sell-off, Bank of America has slipped below those 12-month highs. Beyond that, if we go to a longer-term chart, let's switch up our chart to like a 10-year view. Look, it's kind of interesting where this 50% run has taken us. Positioned BAC, it's been right in this cluster of activity at previous all-time highs, stretching all the way back to 2021 and 2022 as we transitioned between those 2 years. So a technical trader here might be thinking, if they owned, let's say that they own shares, like we own shares in this example portfolio at $36. Well, this has been a great run up, but now we may be encountering a few concerns. Maybe profit taking by our fellow shareholders, maybe technical obstacles on a chart, and maybe who knows, big surprise that could be dropped on this chart in the form of an earnings announcement. There can be a number of motivations for adding protection to an existing stock position. So that's the backdrop. We are going to be talking about using options to hedge the risk in this position. But what else might a trader choose to do? What else might a trader consider doing if they're already happy with the distance that a price has run up? Well, they could just decide to sell shares. We own 100 shares. We could go sell 100 shares. Maybe we can sell a portion of those shares. That is one risk mitigation technique, but there are pros and cons to doing that. Number one is if we sell our shares, the ride's over. There is no upside remaining in that position. We could retain some upside, maybe by retaining a portion of those shares, but now the remaining shares could surrender gains. All right. Yeah, there are pros and cons to each of those decisions. Also, I can't get deeply into tax considerations, but maybe a trader doesn't want to sell for whatever their tax motivations might be. They just want to, there could be a range of reasons why they decide, I would prefer to hold on to shares, even if I suspect there could be some choppiness in the short term. So if they're holding on to those shares, what might they do to help mitigate the risk? And that's going to take us to our protective put. Now, How many of you are familiar with a protective put strategy? I see 136 people watching right now. I see a lot of good chat back and forth. That's fantastic. But how many of you are at least familiar with this protective put strategy? What we're going to do here, if you're not familiar with this strategy, is instead of selling the shares, we're going to go enter into a contract where we contract the right. We purchase a contract that gives us the contractual right to sell our shares if we decide to later. That's the idea here. So I'm going to go to our trade tab and start to spell this out. Okay, let's go to our trade tab. And with this, oh, look at this. It's trading exactly $47.01, actually $47 and a fraction of a penny right now. So let's say that our trader thinks, well, we're bumping our head against resistance here. There's that earnings announcement that's right on the horizon. That looks like that is 8 days away. So if our stock is really going to sell off, maybe the trader thinks it's going to happen possibly sometime in the next couple of weeks. Maybe they think that within those next couple of weeks, this scary moment may have either happened or subsided. All right. Well, that might help. That might assist with which contract to enter. But for today's example, we're going to get into a contract that has 38 days on it. That might get us past this questionable time up at resistance, this questionable time getting through an earnings announcement. We're going to look at a contract for 38 days. And initially, we're going to look at the $47 strike. So what this would do for us, if we were to buy a put at the $47 strike for the 15th of August, explicitly what that would give us is we'd have the right to sell our shares for $47. So instead of selling shares right now, we have the right to sell our shares at any time for the next 38 days through the 15th of August for $47 per share. Now, that's known as a put option. And the way that I think about this, we'd have the contractual right to put our shares, if we no longer want them, into someone else's account through a forced contractual sale. Now, this is not a free contract. It comes at a cost. And it looks like that's going to cost us maybe a little bit less than $1.50 per share, somewhere between 145 and 147. So here's going to be our example trade. It's going to be a protective put. And explicitly, first thing it requires is ownership of shares. What are we protecting if we don't own the shares? So we own 100 shares in this case. And 100 is just typical. These are standard contracts. So each contract represents a potential exchange of 100 shares of stock. There can be some non-standard contracts, but those would be displayed in purple as a little visual cue here. These ones are in black. We can see that those are standard contracts. We own 100 shares. And in our case, we own those at $36 per share. But this is where the protective put comes in. We're going to buy one contract per 100 shares. Buy one of the 15th of August. This example, the $47 put. And that looks like that's trading still, yeah, let's call it $1.45. We don't know. We haven't placed the order yet. We haven't seen the order get filled. If it does fill, let's assume that we get filled for $1.45. Let me make this nice and bold so everybody can see it a little bit better. But I want to talk through some of the pros and cons of this approach. We'll talk about explicitly, I'll revisit the logic of what we're doing here. But I just want to talk about the pros and cons. I'm going to list these off fairly quickly. Number one, to the pros is that we have a contracted, not a contracted as a narrowed, but a contracted, a contracted selling price. Number two, we have limited cost to set this up. Number three, among the pros, is that the trader can choose to keep the stock. They don't have to sell it right away. And number four, this is a flexible strategy regarding timing and the degree of protection. We do this. I'm going to put a little colon there. So that's fun. We'll come back and talk about each of these in a little bit more detail. But I also want to list off the cons. It's not a strategy without flaw. There are pros and cons to this approach. There is a cost for this protection. It does limit potential gains for a period of time. It offers protection, but for itself, a limited time. In other words, there is theta exposure, for those of you who are familiar with that phrase. And risk is reduced, but it's not eliminated. Okay, so let's talk through this. First of all, we have a contracted selling price, a contracted selling price. If we own 100 shares and we're looking at it's $47 per share instead of selling right now, if we buy this put, we're spending $1.45 per share, but in exchange for the next 38 days or through the 15th of August, we have the contractual right to sell our shares for $47 per share. So let's make that a little bit more real. Here's our stock bumping its head up against resistance. There's our expiration for these August contracts, August 15th, 2025. How far could this stock fall in the next month and a half? Particularly if we look at this from the backdrop of what it's done in just the last 3 months. This stock has gone up 50% in just 3 months. As a matter of fact, it did it in the last 3 months because it's now spent 2 days coming down, and this wasn't even 3 months ago. So it's been like 2 months and about 4 weeks. Well, there's a saying in the trading world, and that is stocks tend to climb stairs and then fall out windows. What that is referring to is that the rate of ascent, the rate that a stock goes up tends to be slower than it goes down. And you can kind of see that in very recent history. Right before we started our climb, look at this maybe 2-week period, 3-week period. Our stock was trading here at $44, and within a couple of weeks, it was down at $33. That's a plus 20%, more than 20% sell-off in just a couple of weeks. So if this stock gets its mindset to fall, how far could it fall over the next 6 weeks? Could it get back all of the territory gained? It could. Am I saying that it's going to? Nope. But these are some of the concerns that might be prominent in a trader's mind when they think that a stock has reached a potential fulcrum or turning point. Yeah, Hiram, exactly right regarding the rate of change here. Well, if it does fall, let's say that our stock just collapses. It goes down to $40. It goes down to $38. It's down at $36 by our expiration. Well, even if it's back down to what we paid for it, what right do we have over here? Well, we still have the right to sell our shares for $47. We could still sell those shares at $47, and still, if we bought the shares at 47, we still, at 36, we got to sell them for 47. There's still an $11 profit there. Almost. This did come at a cost. Well, how much did it cost to provide this significant degree of protection? Well, in this case, it was about $1.45. Now, that's an assumption because we haven't actually placed the trade yet. But yeah, to limit that downside risk, it's not eliminated, but it is dramatically reduced. Even if this stock, I don't know, Bank of America, let's say they just decided to, after however many years they've been in operation, they say, good enough, we're going to fold up the chairs, we're going to draw the shutters and close up business. The stock drops to a penny per share. We would still have the right to sell our shares for $47. That we paid $1.45 to do that. So that would still offer over $45 of protection in a dramatic collapse. I'm not saying Bank of America is going to shutter its windows and doors in the next month and a half. If it happened to have something catastrophic, we still have that right. And it came at a limited cost. So boy, this is really sounding like a sales pitch. Some people might be drooling about this. No, no, no. Don't get too excited. It's not a perfect strategy. Now, here's another thing that can be significant. The trader isn't actually required to sell the stock. And as a matter of fact, you might think, well, isn't the purpose of buying the protective put so that we can sell the stock if it falls in value? Actually, no. In most scenarios, the trader does not actually want to sell the shares, even if they drop. Now, I can't speak for every trader out there, but really the ultimate objective, very likely here with our put, is that if the stock starts to fall in value, that put is likely to gain in value, and that gain might help to offset this unrealized loss on our stock. So I want to talk about that for a bit. But we're not required to sell our stock. Now, if we kind of fall asleep at the wheel, we let this get to expiration. If the stock is worth less than our strike price and we let the contract get to expiration, that contract will be assigned on our behalf. And we will sell the shares for 47, even if we didn't want to. So we have to be aware of that. Ram says this strategy is if you own the stock to begin with. Exactly right, Rams. Yeah, this is a protective put strategy. It's a strategy that a stock owner might consider doing at times when they think their stock is about to go through a rough patch. Yeah, exactly right. Now, there can be potential benefits to keeping the stock stretching beyond, well, just what I've mentioned already. Number one is for some traders, they may have their own tax reasons. I'm not going to explain what those might be because that would be outside the scope of my role. But yeah, there might be considerations along those lines. But also, if we sell the stock, there is no more upside potential. If we see this at $47, look at this. Look at this. It was at $47. Which direction is it heading right now? It's actually going up a little bit since we started our discussion. And if it starts to rocket upward, if we sold the shares, well, we're not participating in that. We don't get to participate in a recovery. But if we keep the stock and the stock does go up, there actually is potential for gains, even with the protective put in place. It does not eliminate the upside potential. If this stock were to rocket upward, if it were to go, let's say that we thought we needed protection over the next 38 days. Turns out we didn't. I'm going to just map out a quick scenario here. Let's say we get another month and a half, like the last month and a half we've had. What if it goes up another 25%? What is 25% here? That might take us, let's do some rounding here. Let's say it goes up $12 from here. So that would take it up right up close to $60 actually. So let's say it does this. Goes up there. Well, we have the right to sell shares at $47, but if there were 60, are we obligated to sell those shares? Nope. In that case, maybe we didn't need this put. Maybe we've dumped the put somewhere along the way, or even if we still have it, it might turn out that this was a waste of money and we lose the $1.45 investment, but we do still own the shares. And so if the shares are worth 60, we've made that unrealized capital appreciation gain minus the wasted $1.45 that we spent. So keeping the stock allows for that upside potential. Number of reasons why a trader might choose this over just selling shares. But I did want to talk about the degree of protection. There is some flexibility here in the amount of protection that's offered. So I want to go to the trade tab. And looking here at our option chain, we were looking at the $47 put. Let me throw out a question to our more veteran traders who are here who've said that they've used protective puts before. Let's assume that our stock, which is actually ticking upward, actually fell $1. Let's say it happens in the next few hours. Falls $1. Ouch. We had some 100 shares that were worth 47. Now we have 100 shares that are only worth 46. We have an unrealized reduction in our profits, because right now we're profitable, reduction in our stock profits of $1. How much would this protected put offset that? There's actually something right here on our chart that shows us the degree of protection that we're getting. We can look right here at our delta. Delta tells us how much. It can tell us, number one, it can tell us the probability of a contract expiring in the money. That's one potential use of delta. But another one, it tells us how much our contract can make or lose if the stock goes up or down $1. So if this stock goes down $1, this put would actually increase in value by about 46 cents. That's setting time decay and volatility changes aside. So if our stock falls $1, ouch, we have an unrealized reduction of our stock value by $1, but our investment in our put has gained 46 cents, and it's actually reduced that risk exposure by 46% on that first dollar. Yeah, Kevin, about 46 cents per dollar. And interestingly, if it fell another $1, that protection grows. All right, now somebody look again and tell me how much protection would be offered as a percentage of the next $1, roughly speaking. How can you gauge that? I could look right down here. Let's look one strike below, $1 below here. We have a delta of 56. Yeah, the put would likely grow by 56 cents on the next $1 drop in the stock, and that next $1 drop would be mitigated to a degree of 56%. The further the stock falls, the more that protection really kicks in. And in any case, if we ever decide to, we could just exercise the right to sell our shares right at $47 per share. But really, the objective for most protective put buyers, I can't look into the minds of everybody, but a number of protective put buyers, most in my experience, I'll phrase it that way, they're not really looking to sell their shares at 47. Instead, they're just looking to make some gains if the stock goes down, make some gains on the put, and then sell the put at a higher price to help offset any short-term losses or short-term reduction in profits that they've seen on their stock position. So, yeah, there's some protection here that's offered, but it's flexible. We chose as our example the $47 strike. Maybe the trader didn't need so much protection. Maybe they didn't want to spend $1.45 for a relatively high degree of protection. They just want some protection at a lower cost. Well, maybe they'll choose a lower priced option then. If we were to buy, let's say let's compare this to the $45 put. If we bought the $45 put, it only cost about half as much as the 47. That would give us not the right to sell our shares at 47, but the right to sell our shares at 45. So it's not as favorable a benefit, but it also comes at a lower cost. Another impact is if the stock falls $1, we get less initial protection. You can see that right there in that delta. Instead of having 45 or 46% protection, we're getting 27-ish% protection. So that's very flexible. If the trader wants more protection, Guy says, if I fail to sell the put at expiration, what happens? It's a great question, Guy. I hinted at it earlier. But the bottom line answer is it depends on whether the contract is in the money or out of the money. If the contract is in the money to any extent, a penny in the money, in other words, if that stock is 1 penny below $47 at expiration, better plan on that contract being exercised and the shares being sold at $47, even if we wish that they weren't. That's what happens. Brokerage firms are required to exercise all in-the-money contracts at expiration unless there are explicit instructions left by the contract owner to do not exercise. Yep. Otherwise, they get exercised. So yeah, the shares would be sold for $47. If the shares are higher than $47 in value, it doesn't make sense at expiration to assign that contract. If let's say they're worth $48, well, selling at 47 would be to the owner's disadvantage. those contracts expire worthless. All right. All right. So, yeah, there's flexibility. We can buy protection, and we can actually buy as much or as little protection as the trader desires. So if we wanted more protection, maybe we spend more money that delivers a higher degree of protection. Like, let's say that we bought the $49 put. We'd have the right to sell the shares for $49 instead of $47. That's an obvious advantage on the exercise price. As well, we have a higher percentage of protection. If the stock fell $1, that initial dollar would provide about 67% protection on that $1 move, as opposed to 45 or 46% on the first example. Guy says, so it isn't a right, but an obligation to sell? That, yeah, Guy, it's another really good question. I like how you phrased that, because I said earlier that we have the right to sell our shares at $47, but not the obligation. That is a true statement until the moment of expiration. If we hit expiration while in the money, that right changes to an obligation. Yep. Unless we've less explicit instructions with our broker not to exercise. Do not exercise. That contract will be exercised at expiration. So how do we avoid that? Trader might just sell the contract before expiration. If they want to, they can assign it or exercise it before expiration. But yeah, I think speaking for most of the trading scenarios that I've seen in my long time doing this, most traders are just interested in, let's sell that put before expiration. Let's see, Hiron says, if you're buying a put, is it not a good idea to buy the option when the delta is 50 or lower? It just depends. As I mentioned, the lower delta comes at a lower cost, but provides less protection. There are pros and cons. There are pros and there are cons. So John says, how do you provide the do not exercise instructions? You call your trade desk. Anyway, let's talk about cons for just a moment. Not just a moment, but give it equal due, because I think that's a good idea to understand both sides of the equation. If we feel ourselves getting really excited about a strategy because it sounds so good, what's very likely happened is that we've ignored the other side of the equation, and we have to give both of them full treatment in order to make informed decisions about what's appropriate for one's portfolio, what might not be appropriate. So one of the cons, an obvious con, is there's a cost to this. We're spending $1.45. That's $145. Now, that's going to provide for us for a period of time the contractual right to sell shares at a fixed price. That's good. And as a matter of fact, one of the benefits that's commonly mentioned in owning these is it can provide some peace of mind for a period of time. But we don't want to be too dismissive of this cost, because if we do it once, it could be a significant cost. If we do it time after time after time, every time we get scared, that can really add up over time. It can really put a drag on even a strongly performing stock. So let's not dismiss this cost. Number two is, because of that cost, it puts a bit of a drag on gains. We've already talked through that. If our stock goes rocketing up, that's great. If, let's say, it's gone from 47 up to 60, that's a $13 increase in whatever, in this case, it would be an increase in unrealized gains on our stock position. But our put that we thought we might need to mitigate risk, turns out it's not necessary, and it's really losing value. Our $1.45 investment may have bled all the way out by then. It might not be worth anything. So instead of having an additional $13 of gain, we've got $13 of gain on the stock minus $1.45 of unnecessary protection. So a net $11.55 there. So it can limit the gains. It does not eliminate gains. It limits gains to the extent of the cost of the premium. All right, number three. It's not an unlimited amount of protection we get for an unlimited time frame. In this case, we spent the $1.45, the $145, and that got us the right to sell shares at $47 per share for 38 days. So if the stock doesn't go down significantly at some point in that 38-day window, that may have been a wasted investment. So this is exposed to theta, which is just the time decay element of options. Each day that goes by and it turns out we didn't need the contract, that contract is losing value. Now, finally, risk is mitigated but not eliminated. Let's just run through a rough example again. Let's say that our stock drops back down to 36 bucks. It drops right back on down to what we paid for the shares. Well, one way that we could have eliminated that risk is to sell the shares. If we sold the shares right now, $47.05, that's just a realized gain, $11. We're done. Well, if we hold on to the stock, we buy that protective put, and the stock falls down to 36 bucks, well, great. We have the right to still sell shares for $47. So it sounds like the same outcome. They're only worth 36. We can sell for $47 more. Yeah, but it cost us $1.45 to do that. So that $1.45 in that scenario represents the risk of this trade. That $1.45. So yeah, Hiron says it's kind of an insurance. Well, it's not exactly insurance. There's some. I hear that analogy. I can definitely see how that analogy makes some sense in some way. One thing that we have to be aware of, though, let's just do a quick comparison to like fire insurance on our house. Fire insurance provides a bunch of protection for a pretty small amount compared to the price of the asset that we're protecting. Why is that? Because there's not much chance. I don't know what my fire insurance is for this month. I probably should know, but it's not a lot. That's because there's almost no chance my house burns down this month. And so we get to the end of the month. Turns out I didn't need the insurance. That was a cost. So there was a risk in doing that. It just wasn't a lot of risk. When we buy a protective put on a stock, if we're trying to insure against something negative happening, there's actually a strong chance that in the next 38 days, something very negative could happen. And so the cost is way different than just typical insurance coverages. So yeah, that's just one example of how the insurance analogy is. It has some faults there, but I can understand what you're driving at there, Hiron, and it's not like you'd be the only one comparing this to insurance. But I think that's sort of underselling the real costs of this approach. Okay? All right, but in any case, yeah, there are pros and cons. Hey, we have a contractual right to sell for $47. It costs us money, but it was $1.45. We get to keep the stock, and we have flexibility and protection, and we can put this on at the moment we choose to. We can sell it at the moment. We're not guaranteed perfect liquidity here, but the trader, generally speaking, can choose when to get in, when to get out, when they need protection, and when they don't. That's nice. Cons, though, cost is a consideration. It does limit gains. It does it has limited protection for a limited period of time. And there is still some risk in doing that. So let's go place our trade. I wanted to point out a couple of other things as we go select a put. I've sort of touched on timing and the degree of protection, that the flexibility there. So when might a trader choose to buy a protected put? Could be influenced by a number of things. We've already hit on quite a few of those. Really, anytime a trader thinks that stock is likely to go down for a period of time, that might be the time they choose to buy a protective put. So it might be because the stock has just run up so far and they feel like it's getting top heavy. It may be that their favorite technical indicator is starting to indicate bearishness. It might be that we bumped up against a price ceiling and we're coming down, or quite commonly, maybe there's an event that's over the horizon that they can see coming and they just prefer not to deal with a full exposure to that. So for example, this earnings announcement, it could go great. In which case, if the stock pops up, this put's just going to apply a little bit of drag to that performance. On the other hand, if it goes very poorly and the stock collapses on this earnings announcement, well, we still have the right to sell shares for 47 bucks per share. So timing could be for a number of reasons. In this example, I'm going to say our trader is most concerned about the earnings and that we appear to be up against these resistance levels and pulling back from those, right? So how much time, let's say that our trader is ready to go place their trade and buy some protection. Well, how much time might they choose to purchase here? Because we can buy contracts for protection going anywhere for just 3 days worth of protection, all the way out to 700 days of protection in this case. Well, the fewer the days that we buy, obviously, the less expensive that protection is going to be. So the trader probably wants to choose a period of time, pick a period of time where bumping up against resistance, if we have an earnings announcement, decide how long do I feel like I need that protection for, and then maybe as a general rule, buy about twice as much time as needed. What that can allow the trader to do is to get through the rough patch, and if that put is no longer needed, they might be able to sell that put while it still retains some value, recapture some of that invested value. Byron says, protected put and a covered call. Would you please explain briefly? I can't go into a covered call in the remaining couple of minutes that we have in this webcast, but we do have other webcasts that you can check out. I'll show you those in just a moment. So now we just need to decide on, let's say that we have our events coming up in the next couple of weeks. Let's buy a contract for 38 days. And then we just need to choose how much protection the trader wants. And Delta might be the guide there. If we go for the less expensive contracts, it's going to provide less protection. More expensive contracts provide a greater degree of protection. And I think for today, I'm just going to go with the at the money strike. Spend that, might be a little bit less than this, might be $1.40 instead of $1.45. But I'm going to buy that one. Okay, so let's go to the ask price. Click on that to buy one contract for each 100 shares owned if we want full protection for each share. And all right, let's say that we're willing to spend up to the $1.45 that we've been talking about the whole time. We very likely will spend less than that. We're just going to set that as our limit. And let's click confirm and send. We're going to buy one $47 put. Now notice I don't have to tell the system that this is a protected put. As long as I'm buying it in the same account where my stock position is held, it just works out. Okay. But we're setting a 145 limit. This is going to give us a max profit, max loss. I wouldn't worry about that because it's being combined with a stock position. There is a commission to be paid here. What can really be lost on this protected put is the full amount invested. If it turns out we don't need the protection and it expires worthless, that's how much we could lose on the put. And let's send that order off and see if that gets filled. I'll bet it does. We're offering 145. It's trading at 142-ish. We'll let that trade continue. There it is. Bought that strike for 143. All right. Guys, we've accomplished what we set out to do today. When we kicked things off, I wanted to take a quick look at the markets and talk about why at this period of time, some traders might be out there thinking, ooh, kind of spooky up at these high levels. Stocks could come crashing down. I'm not saying they will, but this is one of the strategies that a trader might consider if they encounter those sorts of scenarios. So we talked through what a protected put is, the pros and the cons of this strategy, and we've even placed an example trade in our portfolio. So I hope that was helpful to you. This is what we do on our Tuesdays. We talk through options, understanding options. So I hope you'll put it in your calendar to join us each week or to just watch the archive. That works just great too. But I want to make a couple of suggestions for you. This is going back to the question about covered calls. If you have an interest in a specific topic, our education very likely has covered it in good detail in the past. But make sure that you subscribe to our YouTube channel first. So go down the lower right-hand corner if you haven't done this already and click on the subscribe button. It only takes a second. It doesn't cost anything. But our YouTube channel is where we house all of our previous webcasts, or the vast majority of them. And you can find those organized into neat playlists according to topic. So for example, you can go to playlists and find my playlist. Let's scroll. Mine's pretty much all the way down at the bottom. And I think it has Barb's face on it right now because she filled in for me recently. There's Getting Started with Options. You can view that full playlist right there. Or another thing that you can do is just search for a topic of interest. For example, let me just type in covered, and we'll see discussions of covered calls and other strategies like that. You can also join our live streams here. Another suggestion I have is that if you have an account on X, give us a follow there. It's the best place to connect with us in between these live streams. You can find Connie on X at Connie Hill CS. You can find me there at Cameron May CS. And I post market information. I conduct polls here. It's a great place to interact with your favorite presenters. You can even see what I did yesterday after doing my webcast. Had a nice, sat out at the lake. It's right across the street, so it's not like I went a great distance. Anyway, thank you, everybody, for all the thumbs up. I can see out of the 123 people watching live right now, 47 have already clicked that like button. That's always appreciated. Click the like button when you enjoy a webcast. It gives a boost to our webcast in the YouTube algorithm. It also is like applause. Everybody, I'll let you go enjoy the rest of our webcast. I'll look for you in a future webcast. I'll also look for on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.